Good afternoon, everyone. We are just going to give a quick moment for attendees to file in, and then we will begin our program. Thank you. Good afternoon, everyone. Welcome to today's webinar on the topic of M&A and perspectives on maximizing your valuation in the communications market. On behalf of everyone at Rev.io, I'd like to thank you for joining us today. I'm Patrick Elliott. I'm Rev.io's VP of Marketing, and I will also serve as the moderator of today's panel discussion with our experts. I want to thank everyone who's joining us on today's panel. And I see on our guest list that we have many familiar names to us at Rev.io, and it's really great to see you, and it's really great to be in touch with you today. Before we get into the webinar itself, the panel discussion, I'd like to go over just a few housekeeping items. Firstly, audio will automatically come in through your computer speakers. Secondly, a recorded version of this webinar will be emailed to you within 2 days. And thirdly, we will be having Q&A at the end of this event. So throughout the panel, please submit your questions via the Zoom control panel at any point during this presentation. So a few more have filed in. So again, welcome to this M&A panel webinar. Again, this is perspectives on maximizing your valuation in the communications market. We are joined by 3 very successful and distinguished guests that I think will offer very unique perspectives on this topic. Now, of course, there is a lot of content in the marketplace right now about M&A and valuations, just a lot of discussion going on about the topic at present. Now, obviously, that is because there is so much M&A going on right now, but it's also, of course, because a lot of people think they have something insightful to say about it compared to the next person or the next group. But even with so many people talking about this today, I think our panel is going to be very unique and very value additive for 2 reasons. Firstly is the fact that we have 3 very unique perspectives on offer. We have a CEO who's recently led a company through an equity capital raise. We have an investment banker from a firm that's been extremely active in the current environment. And we have a very experienced analyst focused on the technology space who's well up to speed in the current market environment. Secondly, this is a program geared towards companies within the orbit of Rev.io, very successful companies, but also many who are grappling with some of the questions and considerations that we're going to talk about today. So we hope that we can provide really unique perspective to this space, and all the speakers will be able to take their very deep experience and bring a lot of it to bear for those of you in the audience today. So without further ado, why don't we turn it to our panelists and go through some introductions here. So Brent, would you like to go first?
Sure. Thank you, Patrick. My name is Brent Moropis, and thank you everybody for joining. I am the, as Patrick mentioned, I'm the CEO of Rev.io and look forward to participating in this panel.
Thanks, Brent. And Renee?
Yes, thank you. My name is Renee Shaning. I'm a managing director and partner at Elantra. Had the pleasure of working with Brent and the Rev.io team as they sought their, out their alternatives in participating in the equity capital raise last year. I've spent the last about 20 years in technology and investment banking, consulting research largely in the Bay Area, and happy to be here today.
Thanks, Renee. Happy to have you on. And Andrew?
Hey, Patrick. Thanks for having me. Happy to be here. So I'm with a firm called MGI Research. We're an independent research and advisory firm with a specialized focus in the area of what we call agile monetization. And previous to MGI, have spent time as an industry analyst, as a tech industry banker, and actually as an operating executive and board member of both public and private companies. So I've kind of seen it from all sides of the table. And one of the things at MGI we focus on is a lot of independent valuation work. So happy to join you.
Thanks, Andrew. It's great to have you on. So we will dive right in here to our first question. My face will disappear, perhaps to some people's delight, but we'll have the questions over on the left side of the screen here. So the first one is actually a two-parter, and I think here I'd like to start with Renee. So the question's, Renee, two parts. What's the current pulse for M&A activity, and is this hot market going to continue?
Yeah, it's a great question. Everyone always wants to know, right? And I wish I had a crystal ball, but I can definitely say that the current level of activity is extremely high. I mean, we're in the sectors that we track, IT services largely in the mid-market. We're seeing a lot of activity, not only among strategic buyers, but financial sponsors as well. And both are paying pretty high multiples for the types of businesses that we're seeing transact. So yes, the market is extremely robust, and then the question is, will it continue? I definitely think that, for the foreseeable future and for the rest of the year, definitely, there's some questions around, what happens if cap gains rate ends up going up next year. There's a threat of inflation. So that could, potentially put a bit of a dampener on the market. But those things are always kind of in question. And again, I wish I had a crystal ball, but for the foreseeable future, the market, I think, will remain pretty active.
Great, thanks, Renee. Great perspective. Andrew, what do you think about this question?
Yeah, I think there's a couple ways to look at it. The first is there's an enormous amount of dry powder on the sidelines, over $1 trillion, that needs to get invested. So that's going to happen. And then the second thing that we always forget, but happens in these phases of the economy and the market, which is there's a lot of activity right now, but there's also a lot of buyers who are sitting on the sidelines waiting for multiples to come down. And so if and when valuations start to come down, you'll see a whole new category of interested parties step into the market and be very active. In particular, corporate buyers, strategics, they'll step in once you see kind of the top come off of the market. So I think there's a long way to run in the M&A space here.
Seems like a pretty interesting paradox to where you've got valuations which are robust, some would argue high, and yet the point you make, Andrew, about all this dry powder, I believe you said $1 trillion worth on the sidelines, and some parties waiting for that, perhaps a dip in valuations to get involved. It's interesting, and yeah, that would suggest the bull has a lot to run here when it comes to private market valuations. So it's a very interesting data point to give. So if that's the market kind of setup that we have here, let's look at how this looks from a company perspective. So this question first, I'm going to ask you, Brent. To maximize valuation as a company, what are some of the short and long-term things that you'd need to do?
Sure. Let's start with long-term. I think having a predictable growth model, understanding sales cycle, what it takes for you to drive top line growth, that creates a predictable forecast for the future, and investors that's going to be appealing to investors, right? They want to know that this business, if we do put more fuel behind sales and marketing, what's going to happen. So having a really well orchestrated sales model can certainly be a huge factor in valuations. doing it over a period of time and showing track record, strengthens that story. And then you look at the other metrics. You want to have professionalized financials. I think churn is critical for recurring revenue businesses, like most of, if not all of our customers are focused on, and same with Rev.io. Understanding the lifetime value, your gross margin, and in the communication space isn't as big of a deal, but in others it can be your addressable market. Communication space has a fairly ubiquitous market to go after. But you want to understand your total addressable market, because again, that would show an incoming investor if there's enough run room for the next buyer, because if they're investing in your business, they eventually want to exit that business with a nice return. And that means there needs to be a buyer there ready. And so understanding the addressable market and how much of it can support your growth and how large it is to support your growth is important. Then I would say things like product differentiation and culture. And so, those things really factor into your ability to really actually get things done inside of your business. And, employee morale and happiness typically translates to, customer happiness and ultimately retention. So they all sort of intertwine. On the short-term side of things, I think as fast as a business can become diligence ready, they are then positioned to take advantage of a short-term opportunity, right? So usually short-term, something that just sort of comes about and happens is because a business has put itself in the right position at the right time, which is why I started with sort of the long-term view of things. If you take a long-term view of things, I think you're actually positioning yourself to be able to take advantage of a short-term opportunity, such as market timing, right? But in order to take advantage of market timing, if valuations are extraordinarily high, if there's a flurry of activity in the segment that you serve, people will look at your business, and give you a larger valuation if they see transparency and they see the long-term view that you've taken with your company. And therefore, I think that's how you take the best advantage of short-term opportunities.
Awesome, Brent. Thanks. A lot of great information there. Renee, from your banker's eye, what do you think about what Brent said there, and what would you add to the discussion on this topic?
Yeah, I definitely agree with what Brent is saying. Valuation oftentimes is a little bit more of an art than a science. Selfishly, I would say to maximize your valuation, you should hire an advisor. but more seriously, I think tracking your metrics are very important. Echoing what Brent said, if you're a recurring revenue business, really understanding your retention statistics, the longevity of your customers. Potential buyers will also want to see other items, so your sales and marketing statistics as well. Do you have a pipeline ready to go? What has it changed over time? What are your close rates? How have they tracked over time? So kind of understanding those types of metrics is really important. Oftentimes, buyers will want to see your backlog. So I think, having that type of information readily available is definitely super important. Additionally, the profitability is important in certain industries. Less so if you're in a very high growth sector, that can become a less critical metric. But, going back to my first statement in terms of the value of potentially hiring an advisor, you may get some inbound interest in your business and decide to forward those conversations. But, having an advisor kind of help you through a process where even, if you do decide to engage with that party, that provide an unsolicited interest in your business, the threat of actually running a process can be very powerful to keep those conversations on track. So I would say that, to consider hiring an advisor.
Excellent stuff. Brent, I want to go back to a couple of things that you said as we pivot really to the third question here. And you talked about a lot of metrics before in terms of sales and marketing pipeline, gross margin, certainly the total addressable market. And at Rev.io, As many know, we're a very data-driven organization, very kind of hard data, tangible data. Thinking about actually intangibles a little bit here, you also mentioned culture. Can you go a little bit more in depth in terms of where team and culture fit into this discussion?
Sure. I mean, the culture at Rev.io is near and dear to me. I think first and foremost, you have to have, aligned values. Then assembling a leadership team that can scale is critical. There are plenty of executives out there that are really well equipped to maintain a business and basically keep it going and operating well, but it's a different breed of executive that you need to be able to truly scale, because they're going to need to transform their team as your business scales, and the business needs to evolve and change with that scale, and therefore it certainly takes a different type of executive. So assembling that right leadership team is one of the hardest things that I've had to do, but the one of the, if not the most impactful, because they really then drive the rest of the culture. And so, from there, you need to create, for me, it's been creating a metrics-based organization, so quantifying as much as we possibly can, so that down to the individual, your teammates know what success looks like, and then they can go after it and attain it. Then at a macro level, understanding what's going to drive valuation and then aligning your culture around it. A good illustration for Rev.io is we focus ourselves, the executive team, on a rule of 40. That's our year-over-year revenue growth. We only include our recurring revenue. And then you add our trailing 12 months Ebitda, we target for that to be at or above 40. And therefore, if growth slows, then profitability grows. And if profitability sort of declines, then growth should accelerate. And that really is a great simple metric that has helped myself and our executive team really focus on the driving value and also operational excellence. There's a few other things that we didn't mention, though, is around culture, is then making sure that you drive it home through that leadership team and have alignment, and you structure a cadence of communication with your team. It's really because to grow a business, again, it has to be changing. And so for us, what's worked is to consistently be open and transparent with our team on a monthly basis, breaking down, this is the direction that we're going and this is why, and then disseminating that out throughout the organization through the leadership team to make sure that the entire team, so their efforts and really all their energy is on changing into the direction and formation in which you're trying to align the business so that you can scale, versus their energy and stress going to, why are we doing this? Why has my job changed a little bit? Why are we reorganizing? They shouldn't have to think about those things, because it takes mind share and energy, and therefore it will work against the business. It creates an inertia to the change that you're trying to accomplish to be successful. And so, I would not underestimate the need for reinforcing why we're making these changes, what's going to come as a result of it, what's in it for everybody, and then asking for everybody's participation. People, I believe, are motivated when they go to a company. They want to make a difference. They want to be proud of what they do. They spend a large percentage of their life working, and therefore it would only make sense that we want to make an impact. And so you can't make an impact if your company isn't it's really structured for you to see what that impact is to the business. And so that's where we spend a ton of time from a metrics perspective, and also culture and alignment in terms of the direction and positive change management.
A couple of things really stand out, Brent, in your comments there to me. Certainly number one is about being open and transparent with your team about any kind of strategic change that you're making, be it a equity raise, acquisition, or whatever. But then I really like the comment about what's in it for everybody, and going down to the individual level, having people understand, where they fit into an organization that's going through strategic changes. I think is so important. And I mean, I've seen it borne out here in Rev.io as we've operated over the last year or so, and I certainly can back up what you say to that perspective.
Yeah, thanks. And I think to the other point earlier about, being ready and preparing to maximize value, I think the other piece that we didn't necessarily mention that's critical is your product differentiation. And that can come in the form of packaging and pricing. And we see even amongst our great clients, some of them have fetched enormous valuations, and they have access to sell and distribute the same technology as someone who does not. But what they do with it, how they package it, how they price it, and how they serve those customers can really differentiate in terms of dollars, what they're getting for that business when they go to either sell it, exit, or raise capital. And so really understanding, your differentiating factors and being able to explain it in simple terms, and being able to have a track record of growth and success from it is critical as well.
Yeah, totally agree.
Yeah, and I would say I totally agree that you need the help of great partners. Folks like Renee wake up every single day thinking about how to position a business to maximize its value to sell. And during that process, for us, it was an extraordinary time because of COVID. So it took much longer than expected. It was a little bit more stressful. I would imagine that every engagement for the entrepreneur is a little longer and a little more stressful either way. But you want to be able to maintain the success of your company. You don't want performance to tail off in the midst of running a process. And so having the right partner, they come alongside and they put together a book, they organize all the meetings and communication, and they have a full-time job that will take you away from driving the success of your own company if you try and go about it alone.
For sure. And that's a great segue really to the next part of the discussion there, Brent, Renee, to bring you back in. So let's focus a little bit on the financials here. So everything that Brent said, I think, is accurate, but let's just say focused on this. What does a company need to do to solidify their financial profile ahead of a deal?
Yeah, I definitely think there's a couple things that companies need to think about as they're getting ready to set up for a process. You definitely want to make sure your financials are in order. So, generally speaking, you want to be able to hit a button and provide, monthly detailed profit and loss statements in an Excel workbook, for example. And, one of the things to think about is if you're currently doing your financials on a cash basis, which a lot of small businesses do, you may want to think about hiring an accounting firm to convert those over to an accrual basis. Another thing that we've seen is, someone hits a button and here's the Excel workbook, but maybe your gross margins aren't being calculated at all. Maybe you're just showing revenue and expenses and, net income. So, kind of working with someone to understand the importance of, making sure that the financials are being outlined correctly. And another thing too is, putting together, not just a budget, but projections for, 3 to sometimes 5 years. And, oftentimes when we get engaged, we will work with companies to build a bottoms up model. And, what you want to make sure to do is you want to make the projections very achievable, because monthly, as you're going through a process, the last thing that you want to have happen is for you to be missing projections as you're going through a process, because then there's a question of credibility. So making sure that you do have a model that is readily achievable. And another thing that we've kind of depending on the type of business, we oftentimes have advised companies to hire an accounting firm to do a quality of earnings prior to starting a transaction, because what that can help do is unearth any landmines that you may have not even been aware of before even starting a transaction. So so a number of things to think about as you sort of gear up for a process.
Renee, what are some of those potential landmines that a quality of earnings analysis might uncover?
So maybe you've had some one-time things happen in your financial profile that don't necessarily reflect sort of the current state of the business. You want to be able to highlight those things in your analysis. So maybe that is in the form of an add back or something else to kind of smooth the analysis out. Sometimes there's bad debt situations and there may be a story there. And so just, highlighting, those different things and putting in front of a buyer at the beginning so that that's not something that's being found out. Let's say you run a process and you've decided you've picked your partner and you're in exclusivity, and then that comes up. Again, you've lost a little bit of your leverage there.
Gotcha. Thanks for clarifying that, Renee. So at this point, actually, Andrew, I want to bring you back in. There, rightly or wrongly, perhaps is a perception, particularly as we talk about M&A, that it's a large organization's game. And we're very fortunate at Rev.io to serve a variety of clients. They're at very different size and growth profiles as businesses. And I would say, as you've listened to this discussion so far, and with your pretty deep background in the space, do you think there should be any different considerations for small and medium-sized businesses, SMBs, in this environment?
Yeah, that's a great question, Patrick. I would think about it in the following ways. The first is underscoring what both Renee and Brent said. Think about having very good financials in place, because SMBs are under particular scrutiny. Private companies are under particular scrutiny because, from a buyer's point of view, there's always the fear that there's some hidden landmine or hidden risk that is not going to be uncovered in the diligence. So just like a good billing system adds value to your brand by bringing transparency and accuracy to your customer, by having strong financials, having good accuracy, transparency, and all the documentation ready for the process, that's going to be very helpful. And I think speed and agility can make a difference, particularly for a buyer that may be looking at multiple targets. As Brent said, these things, these processes take more time than everybody expects. And the more you can bring speed and agility to that process, which means being really well prepared and having the right partners, that's really going to make a difference. And then the other comment I would make is that, particularly for privately held mid-sized companies that are, say, anywhere between, let's say, 5 and 100 million in revenue, you really want to be mindful of and very intentional of your actions, because you don't want to get halfway through a process and uncover that you really don't want to let go of your baby, for example, or have expectations of valuation that are just simply out of line with what's out there in the market. So you got to really think through, what do you want to get done as a business owner? When do you want to get it done? And what are you going to do the day after? And so that will help then inform how you find the right partner and how you approach the whole process.
I like that comment a lot in the context of, there's a lot of, again, it goes back to that quantitative, qualitative, tangible, intangible, whatever you want to say, but sort of the perceptions of, if you're a entrepreneur who's built up a business and it's your baby, as you said, it's kind of your life's work in many cases. And, having a clear picture of what you want out of a deal, have to be realistic in terms of your expectations for potentially what that sale price is going to be. It's good commentary. And I think probably I'd not to put words in your mouth, Andrew, but probably comment coming from a lot of experience of seeing it go well and perhaps not so well for operators over the years, right?
Yeah, absolutely. And I think, again, going back to having the right partners who can help you structure a deal that's going to be right. Do you want to try to cash out as much as possible? Are you going to get into some type of situation where it's an earnout? You want to make sure that in those, in an earnout situation, that you are going to get paid out, because that's not always a given, in spite of all the loving promises that get made at the moment of consummation.
Mhm.
So you really want to think through, do you want to stick into the business? Do you think there's more potential? Are you willing to take a backseat role once the business has been sold? All those things are really important decisions. How do you want your people to be taken care of? All those are very important considerations before you even begin to go down the path of trying to find a partner.
Great perspective, Andrew. Really
Yeah,
good.
and I think that's interesting too. This is Brent. The other thing about size is I think that folks sometimes overlook this. They look at what they read about a valuation that a company in their space was just able to garner, and then they think they are worth the same. But to me, at least on the institutional side, it seems like, and I'm curious if Renee and Andrew see similar hurdles, that there's a hurdle at around 5 million in revenue. You sort of have the perception now you have a business that can scale. It probably needs to be growing, nicely. And then there's 10 million, and the difference between a $5 and $10 million business, other than the fact that it's twice the size, is less single points of failure, right? You probably have a stronger client base. You may have been able to win some larger customers at that point in time, just because of the company's track record of success, right? You have just more depth to your team, vendor and partner relationships, and therefore there's less risk. And then, so there's a hurdle evaluation there. And then you start to see another run around 20 and another run around 50. And I think those hurdles are important, for folks to be mindful of, because your smaller size, it doesn't mean you have less of a potential, or you don't have a great business. What it means is you likely have more risk, right? There's probably more of a reliance on the founder of the company, and they have to hedge the fact that founder is maybe getting paid, or what is their motive, and if as a founder or someone that's mission critical decided to wake up and do something else, the perception would be that the business at a smaller scale would be less valuable. And you also have more single points of failure throughout the business, and likely there's some clients that will really, really be important to the overall financial profile of the company because of the smaller size. So those things are really, really important. And I think timing is critical when you think about these hurdles, because it's very difficult to go from 5 to 10 and 10 to 20, and you have to, again, it goes back to building an organization. You have to reinvest in the team and take some major risks to get yourself positioned to be at that next level. And sometimes that means burdening extra cost, and sometimes it means that the overall profile for a short period of time, may not look as attractive as it would if you were just trying to maximize for an exit. So, I think the size is important for owners of businesses. You try very hard to not make the business reliant upon yourself if you're at that smaller scale, because that's a risk. Rev.io, we're going to be looking at acquisitions, and when we look at them, we want to examine closely who are the critical players and what happens if they decide to go sit on the beach for the rest of their lives, and they're entitled to do so, but we have this investment. What's going to happen?
And Brent, this is Renee. I definitely agree. There's a big difference between a $5 million revenue company and a $20 million revenue company, and those thresholds that you talked about, 5 to 10, 10 to 20, definitely resonate with me. One of the things that we've seen with some smaller providers that are able to get to that $5 million, revenue level, the difference between a $5 million revenue business and one that's 10 plus oftentimes comes down to sales and marketing. So if you're able to, get beyond 10 million of revenue, it, typically means that, you've spent some time investing in the sales and marketing team, which is an important part of that investment that you would make to then get to the next level of 20 million.
Yeah, and I would just add to that, I think, Brent, your point about having single points of failure in the business, the more you can mitigate those, the better. And being very mindful of some of the trade-offs. There are plenty of SMB businesses where the owners may decide to take profit out of the business at the expense of maybe investing in new systems or investing in additional sales and marketing capability. And ultimately, that's going to have an impact on valuation. So I'm not saying it's good or bad, but just be mindful of the decisions that you make in the lead up to a potential exit. And the other comment I would make, having seen it multiple times, is in frothy markets, you see where a competitor may be taken out for some crazy multiple. And then suddenly the board and the management team just lose their minds and say, well, hey, just because that company got 30 times revenue, we're better than those guys. So we should, only accept prices above 30x revenue. Frothy valuations don't last forever. And just because someone finds an exceptional buyer doesn't mean that you're going to find that same exceptional situation. So you also have to be realistic about what's durable in the market in terms of valuations and how long these unique points in time are really going to last.
I think that's a great point there, Andrew. It's two adjectives stood out to me, what you just said. One is frothy and one is durable. And perhaps it's a comment of frothy being in the eye of the beholder, but durable is going to be what's measured in the marketplace over time, and particularly in the private markets. Everyone's looking for an apples to apples comparison. They say that the person that the company, I should say, that I compare myself for my company most directly to, they got 30x, so I need 40. I can definitely see how that would become a mindset that could become challenging for companies that are looking to make a transaction, especially right now with just a lot of money in the space. But really great discussion on this topic here. We're getting a little towards the end of the discussion topics here. There's a couple more that I'd like to touch on for the audience here. The next one is perhaps a little bit more tactical, but I do think it's very important. And it is in regards to some of those partners we've talked about earlier. So maybe Renee, we'll start with you on this one. How should operators be thinking about accountants, attorneys, and other partners through this process?
Yeah, I think hiring the right advisors that's a critical step. What we've seen is some of our previous clients have hired attorneys that don't necessarily have a commercial mindset. So as you're working with that attorney in the latter part of the process, usually where you're negotiating definitive agreements between buyer and seller, what you want is for that attorney to have a very commercial mindset, meaning their job is to get the deal done, not to necessarily win every point. Remember, attorneys are getting paid by the hour. Sometimes they can belabor certain things and, really kind of draw out the process. Another thing to think about too is hiring tax counsel. Depending upon how your business is structured, if it's a C Corp, an S Corp, an LLC, and then how the purchase is structured, if you're doing an outright sale, that can have, if it's an asset sale or a stock sale, there are different tax consequences associated with that. Other tax consequences associated if you've granted options and sort of what the tax consequences are for those option holders. So getting right, hiring a tax counsel, I think is almost as important as hiring the right attorney. And sometimes those are part and parcel.
Sure. Andrew, what do you think about this?
Yeah, I would absolutely agree with that. And that one, get partners that have seen the movie before. Hopefully they've seen it with multiple endings in Dolby Technicolor, right? So often for an SMB business, that means that your accounting partner that you may be using may not be the right one for a transaction, because you need somebody that can move quickly and understands what the materials are and kind of the pace that's going to be needed to get something done. And likewise, as Renee said, get lawyers that are commercial and who aren't going to dynamite the deal, because lawyers often have a tendency to kill deals. So you need somebody who's going to help you mitigate risk on one hand and structure the right deal. And hopefully folks like Renee and your bankers can help you with that. But you also need somebody who's understands what your end goal is, and aren't going to prevent you from achieving that.
So full alignment across all your partners. It sounds like almost going back to some comments made earlier about making sure that your operating team members within your company are fully on board and understand the purpose and what is in it for them. It sounds like you, in many ways, you have to make the same sort of judgment about the partners you bring on, that they are fully on board and committed to what you're trying to achieve as well.
Yeah, that's right. And the same goes for if you have existing investors and key shareholders, make sure you know what their limitations are, or what would prevent them from getting something done. Because you don't want to get down a path where, say an earnout is put on the table and someone says, well, hey, that's not what I want, and I'm not going to vote for this in any scenario. So you want to make sure you understand what's possible and also what's going to be impossible, so that you can navigate appropriately.
Great insight there, Andrew. Renee, Brent, do you have anything you'd want to add to this topic?
No, I thought that what Andrew said in terms of the experience of the partners is dead on.
Excellent. Excellent. Well, we are coming a bit towards the end of the prepared part of this. So as with any good program, there's been a lot of information that each of you have shared here, but on the close here, we'll start with you, Brent, and then go left to right on the screen. What's the one thing you'd want our audience to take away from this panel today?
The one thing I'd like everyone to take away is to lean into this topic itself and network, right? Meet with bankers before you want to run a process, meet with potential investors, not just if you're getting called on by an associate, try and meet with some of the partners. If your legal counsel is not experienced, seek legal counsel that does have that type of experience, and begin dialogue with them, because one, you're gonna gain perspective from each of these networking opportunities, and ultimately have your own view and opinion on what you need to do for your business, because no one's going to know better than yourself.
Awesome. Thanks, Brent. Renee, any final
Yeah, no,
thoughts?
I definitely agree with Brent. You want to start dialogue early on with advisors and investors. And another thing is, the timing. You may think that, oh, I need to wait until my business is perfect in order to do something, but it may be better to do something sooner rather than later. And we always tell folks, it's better to sell an imperfect company in a great market than to sell a perfect company in a downturn scenario. And so, thinking about timing in that perspective, I think is important.
Hard to fight the market, isn't it? You have to take it. You have to take the market as it's given to you. That's a great point. Andrew, anything you'd like to add?
Yeah, I'd say owning a business is like owning a piece of real estate, and that it needs to be ready for sale at any point in time. And so if there are single points of failure that can be addressed or mitigated, don't hesitate, just like you need to do regular maintenance on a home or a commercial property. Make sure you make those investments before going down any one of these paths, because that could impact your valuation. So always have your business ready for sale, because you never know what can show up at your door.
Excellent. I think that's a great point to end on, and certainly a metaphor that many of us can understand, having been homeowners. So I want to thank each of you for your time and your thoughts on what we've gone over today. Now we're going to turn it back over to the audience, and I'm just going to give a quick moment here for those of you in the audience to maybe queue up some questions for us. But while you're doing that, I'll point out we've got contact information for everybody on the screen here. So those of you who've been invited, you know Rev.io, we're very eager with all of you to potentially open up a conversation again. So please reach out. You can reach out to Brent directly. You can reach out to those of us on the marketing team at marketing@rev.io. Renee's email is on here too for Elantra. If you are thinking about potentially transactions in the future, we can give Elantra and Renee specifically our full endorsement, having gone through this process with her last year. And then Andrew with the MGI team, adaily@mgiresearch.com, can also endorse MGI. We at Rev.io have learned a lot from the market by having a chance to see some of their research and interact with principals on their team. They have an incredible amount of insight, many years of experience. So hoping that this can spur a conversation with everybody you see on the screen here. So let's give it a quick second, and we'll look for the Q&A list to come up here.
I saw a chat too. From
Yes, I see that as well. Thanks, Brent. Yeah, and we can go to that one first.
I think that
Yeah.
for the context of this discussion, I think of like SMB. The question is, can we define SMB? What size companies are we talking about here? We may have answered this, after it was posted, but I think for the purposes of this discussion, we're thinking about, just because of our ecosystem, probably sub $100 million businesses. But then we talked about those hurdles at 5, 10, 20, 50, and there's different perspectives that investors will have based on your size within that spectrum.
Thanks, Brent. Yeah, thank you for addressing that question that came in a little while ago. The next question, I think this is probably best for Renee. Renee, can you describe what a typical earnout structure might look like?
Sure. And I would say it's hard to say, typical. We can say, because we've seen so many different types of earnout scenarios, but, typically when we're working with companies, we try to limit the overall earnout amount to, 20-30% of deal value. So you'll get, some cash up front, and then the rest can be earned in the form of an earnout. And typically that's, 1 year, to 2 years. We've seen a lot of 2-year deals where maybe you'll get one tranche after year 1, another tranche after year 2. And then there's usually some metrics that you get tracked that earnout is based upon. So, that's where we come back to the projections and making sure that your projections are very achievable, because oftentimes the buyer will look at the projections that you put in front of them, in a 12-month, 24-month scenario, and said, okay, well, you said this is what you're going to do, so we're going to hold you to that. And that's what the earnout will be based on. So you need to hit this revenue threshold. And depending on the nature of the business, if it's a services business, there may be some minimum gross margin that needs to be achieved. And if it's a full services business, we've also seen retention be part of the earnout structure as well, where some percentage of your people need to stay. But trying to limit it to 20-30% of the overall deal value, and at most 2 years, I think is a good target.
Great, thank you, Renee. The next question I think is for Andrew, and it perhaps is a bit of a friendly challenge to some of the things we talked about earlier regarding valuations in the context of a lot of money on the sidelines, et cetera. And the question is, how do you explain the enormous valuations being given to companies that have never turned a profit?
Growth, baby. People are paying for growth today. And there's when you have essentially negative interest rates, and a lot of challenges in the emerging markets at the macro level, there's a lot of action taking place in the U.S. markets domestically here, and people are desperately seeking alpha. So the more growth, the better. And while the music plays, that's the tune.
And I guess it's probably fair to assume too, the factors you just mentioned, if those persist worldwide, I assume that would be a catalyst for some of that dry powder, particularly institutional dry powder, to finally jump back into these markets, right?
Yeah, and you'll see, as you see now, the companies that don't have the growth, in part, are the targets for private equity and activist shareholders to go after. And I think what we've seen is that no company is unreachable today. If you look at the pressure that was put on even a company like Apple, where Tim Cook has ended up upping the dividend, when you look at what happened at Microsoft and, Steve Ballmer being pushed out. These are big companies with huge market caps. And even then, activists have gotten in and been able to create change. So I think, right now everybody's desperately in search of growth companies. I think there's a view that technology is going to drive more productivity. And so tech companies and tech suppliers are well situated for probably what's going to be like a 10-year cycle of investment in technology and productivity tools. And so the more growth you can deliver, the better.
For sure. For sure.
I would add to that too. We've actually sold businesses for nice multiples that had never turned a profit. So we have experience with this where services business is growing, 50, 70% plus per year, losing money, yet that growth definitely adds value, and oftentimes depends on the needs of the buyer. I mean, these are strategic buyers typically that are looking for specific capabilities to add. So to the extent that it's a capability buy on the part of the buyer, I think that's where you see additionally high multiples being paid on a revenue basis, because there is no Ebitda, right, to peg that multiple on, for them to acquire a certain capability.
Yeah, and it makes me think of a follow-up to this, Renee, and then in the context of, Brent mentioned Rule of 40 earlier, which is, a critical metric for Rev.io and a lot of companies similar to us. If you do have these companies that are growing 40, 50, 60, 70% a year, presuming in technology, especially, that they have high gross margins, what's the nature, or I should say, what drives the EBITDA miss typically?
So I would say, software businesses aside, because it's a little bit of a different play. A lot of the services business that we've worked with that are, truly growing that rapidly are reinvesting everything back in the business, typically in the form of sales and marketing.
Gotcha. Okay. I think that's important context, because, that core product profitability versus the business profitability and what really drives that, I think is important to mention there.
Well, I also think scale is an important factor as well, right? So if you're, a $10 million business growing 100% a year, it makes sense maybe that you don't have the operating leverage in your business really to turn a profit, because you really are building up a sales and marketing team. Now, if you're a $50 million revenue business, it's a little bit of a different story. Yeah, eventually, I think, an acquirer is going to want to see you turn a profit. Right?
Oh, sure.
Yeah.
No, that makes a lot of sense. I think we've got time for maybe one more question here, and this question's for Brent to close us out. So, Brent, going back to some of the examples you had about culture and kind of vision for team members of the company, what are some practical examples of what you've done to align your team in this period of the company?
Yeah, as it relates to getting into that growth mindset and aligning the team, for us, what we do is we'll spend quite a bit of time weekly leading up to a 3-day executive retreat. During that retreat, we assemble what we call a one-page strategic plan, and that outlines goals for the business over the next 12 months, really a theme of the type of behavior and traits and characteristics we need to adopt to really serve our clients and employees and partners well as we scale. And then we discuss the strategy for disseminating that information. And that has proven, to produce some sort of like hard copy, something tangible the team can reference and look to, such as a one-page plan that has, this is the target we need to meet, these are the goals that lead up to it, and this is the theme that we're adopting that we believe will create the behavior we want at scale. That has been such an instrumental part of the Rev.io story. I can't actually imagine running the business anymore without it. That's how we've aligned folks. And then what we do is we then go over the progress towards it every single month. And we keep it in front of our team, again, because we need to continue to reiterate with clear communication what we're doing and why. And that, as you know, being a part of the executive team has really helped create alignment and uniformity across all segments of our business. And we're all rowing in the same direction.
Yes, 100%. It's something that we all, from our executive leadership all the way down to solid individual contributors that we have here, are referencing that on a regular basis. So certainly agree with you there, Brent. Well, everyone, we're just about at time here, approaching 2:00 Eastern time. So I want to thank Brent, Renee, and Andrew, each of you, for your time today. I want to thank all of our attendees for taking time, especially near the end of the quarter, to join us for this presentation. We hope this was informative. Again, please reach out to anybody on the panel if you would like to learn more and learn a little bit more about each of the companies represented here. And we'll be emailing you a copy of this, a recording of this presentation within the next couple of days. So thanks, and have a great rest of the day, everyone. Take care.